You're welcome.
So, chapter 11 is going to start by giving us an overview of the major characteristics of a corporation. That's what we're going to be doing today. It also explains the accounting on transactions for common stock. Um, Later on, we'll be looking at dividends. And then chapter 11 ends with some analysis on that. But today is learning objective 1-day, which is all about a corporation. So first you need to know, corporations are legal entities. They're created by the state. They basically are, it's a process that you have to apply to become to form a corporation, and that corporation has to have some type of a purpose. And so the first thing that you're asked about is, what's the purpose of this corporation going to be? We're going to be focusing specifically, of course, on for-profit corporations, which means that the purpose of this corporation is to make a profit. And of course, you already know some of the large companies that are for profit. But another purpose of creating a corporation is to actually do something called a not-for-profit corporation, which is an organization whose mission is not for profit. Could be educational, could be charitable, could be religious, could be other related types of mission base, social, for example. So so a lot depends on the purpose of it. So for our book, of course, we're going to be focusing on the for-profit sector, but that doesn't mean you cannot be or you can't apply to be a nonprofit corporation. So again, Salvation Army, American Cancer Society are not-for-profit corporations. They are corporations, but they function for a mission rather than a profit. So that's the difference. Um, Corporations basically, when they all start, um, they're broken into shares of ownership, as you know. Stockholders or shareholders are the owners of a corporation. The question of who can own those shares is another question that's asked. But you should know that all corporations start as what we call a private corporation, privately held corporation, which means the shares of ownership in the corporation are usually held by usually the folks that started the corporation, um, are the shareholders. That's basically it. So if Adam wanted to start a corporation in New York, the application in New York, by the way, recognizes 200 shares of ownership. That's the base. It can go up from there. You can have as many shares as you want, but the base is 200. And Adam is, if he's the only employee and the only person, he can allocate all of those shares to himself, which is why people like Bill Gates, Zuckerberg, Bezos, others
Were you
become
talking about me earlier?
become become billionaires somewhat overnight when
Oh,
their corporation's ownership goes from private to public. Um, that's that's usually how most of them make most of their money. So yeah, Adam, I was using you as an example. That's all, just an example.
okay. Thank
But ownership, for the most part, of most corporations are privately held, which means that the only people who own the stock um, and the only people who can own the stock are the private people that are involved in the company. Okay. There are a lot of companies that are still like that today. Matter of fact, most companies are privately held corporations. You might not know about Cargill Incorporated, but you probably know a company called Bose because they make so much sound related equipment. Um, They're in higher end automobiles. They are all over the NFL. When you see the Super Bowl, the coaches, they're all using Bose equipment on the headphones and microphones and so forth. So they're well known, but they're a privately held corporation. So even though they're worldwide, only Dr. Bose, who's passed since, and his associates and family, only they know how the company is doing because it's private information. Only the owners know. It changes when a company wants to say, we want anybody in the public to be able to own our shares. Okay. Then what they've decided to do is change from a privately held corporation to a public corporation. And so public corporations mean that anybody in the public can be a stockholder simply by buying shares of stock through a broker on the stock exchange. So all the companies that you've heard about that are in the news, that you hear about on the stock market, they're all public companies because anybody in the public can become an owner by buying a share. Now, because there are a lot of public companies, and because anybody in the public can become a shareholder, the government has laws that are administered through the Securities and Exchange Commission, what's called the SEC. And it's the SEC that also works with the accountants in making sure that the financial statements that public corporations provide are structured in a way that it's clear, it's accurate, as can possibly be. So there are rules that are involved for public corporations that are not similar in a privately held corporation. So that's some of the differences there. So again, the purpose is the first thing. We're going to focus on for-profits, clearly. But then almost all for-profits start as private corporations. Only the owners, the people that usually start the company are the owners of the shares. But then sometimes they change to become publicly held corporations, which means they want the public to have a chance to be owners in the company by offering the public a chance to buy shares. So that is sort of the intro here. Corporations are popular because they have many, many advantages compared to the disadvantages. And the advantages are different, of course, for all the forms of business. But in essence, corporations have some distinct advantages over both proprietorships and partnerships. Okay. One of the most glaring ones is that if you're a proprietor, sole proprietor, or a partnership, there's no distinguishing you, the person, from you, the business. Which means that if you were a sole proprietor and your business, you did something that causes injury or harm to others, you're getting sued. Not just you, the business, is getting sued, you, the person, is getting sued. Everything you own is getting sued, is up for grabs. That's what's at risk for a proprietorship or a partnership. That's called unlimited liability, unlimited legal liability. However, when you create a corporation, the corporation is in of itself its own artificial person in the law. So when a corporation is getting sued, the corporation exists under the law as its own artificial being, and so it's getting sued, not the people who run it. Okay, so it's very interesting, and then that provides substantial benefits to know that the business itself is its own legal entity under the law, separate from everyone who works for it. The second thing that I mentioned is based on the same is um, because a proprietor, there's no distinguishing a proprietorship from the person or a partnership from the individual partners. Everything is at risk if you are a sole proprietor or if you're part of a partnership. That's not true with a corporation. The owners of the corporation, as you know, are called stockholders or shareholders. And the most they can lose is whatever they put in to the corporation, because that's the limit. Okay. Because there's a distinction between the corporation as a legal entity and you as a legal entity. And since the corporation is getting sued and the corporation might go under, they separate your personal stuff from that. So the most you can lose in terms of the limits is whatever you've put in. That's it. That's a very important advantage. Another advantage is that ownership changes all the time. Um, so what happens on the New York Stock Exchange and the NASDAQ every day is basically shares of ownership are being traded. People that own the shares are selling them to others, and other people are buying them. And that happens all day long on the stock market. The wonderful thing about that is just because the owners have changed doesn't mean the company has changed, because in a corporation, the management of the company is separate from the owners of the company. And that's different from a sole proprietor, because if I have a business, I am the owner. I am the manager of that business. If I sell my business to another person, the whole thing changes. Everything changes. There's a new owner, possibly new name, new policies, new everything. Everything changes with ownership in a proprietorship, right? Same thing with a partnership. If you add partners or if you delete partners, that partnership has new owners and new things are going to happen because the owners are the managers. That's not true with a corporation. The shareholders are owners, but they are not managers in the company. Management is separate. So that means corporations can function without much change when ownership changes. So McDonald's, I mean, what time is it now? It's about 11 something, right? So there's probably been at least 3-4 million shares of McDonald's stocks already been traded today. That means 3 or 4 million new owners. However, nothing has changed at your local McDonald's because the management of the company is separate from the ownership of the company. That wouldn't be the same if Mike's Barbershop changed to Adam's Barbershop, right? And Adam's the new owner, Mike's no longer the owner. That would be totally changed. Everything, that's a whole new business. That doesn't happen in a corporation. That's why it's an advantage. Corporations basically can raise money simply by increasing the amount of shares of ownership that are available for sale. Like I said, the base corporation in New York comes with, is recognized at 200 shares of ownership. But you can have 200 million if you want. It's just you have to pay a fee to get all the extra shares recognized. What's the benefit of having more and more and more shares recognized is you can get more money, right? You can raise more money by selling shares of stock for money. So that is a huge advantage for a corporation. Partnerships and proprietorships are limited in how much money they can raise based on how much the owners can get, right? With a corporation, you can simply expand the amount of owners you have, and everyone's putting money in. So there's a lot more money to be raised in that regard. Another advantage is the fact that corporations can outlive their original owners. Henry Ford has been dead for a long time, but Ford Motor Company somehow is still surviving, right? That's a continuous life. Walt Disney, whether you think he's on ice or frozen or whatnot, doesn't matter. Walt Disney wouldn't recognize his company if he was defrosted. I don't know how that would happen. But Disney has a continuous life long after Walt Disney passed. Steve Jobs started Apple, was a major shareholder, but he's passed as well. But yet Apple Computer is much larger at this point. So continuous life, it's a going concern. It's going to continue. It's not affected by the death of the owners, right? That's not true. I mean, if I had a barbershop and I died, there's no more barbershop. That's it. Done. The life of the barbershop is done because my life is done. So that's true with partnerships. As partners die off or retire, everything changes because you have to, right? New partners have to have a new agreement. One of the benefits is there is a separation between owners and management in a corporation versus a proprietorship where the owner is the manager, and partnerships where most of the owners are managers, although there are limited partners, which are just basically investors. They don't manage anything actively. So this is a benefit to a large degree. It also is a benefit is that corporations can go and literally seek people who have specific specialties that can help the corporation by being a manager in charge of a VP in charge of, say, manufacturing or marketing or some other aspect that they are a specialist in that. That's not going to happen with a sole proprietor or partnerships without a lot of interference. That's for sure. One of the drawbacks is that when governments do make regulations, laws, whether it's on the state level or the federal level, these laws affect corporations a lot more than they do proprietorships or partnerships. Okay, mostly because of the size of corporations. There may be fewer corporations than there are sole proprietors or partnerships out there, but the corporations are large, very, very large for the most part. And so when governments, whether state or federal governments, make laws, it usually affects the corporations a lot more than any other type of business, which means corporations assume certain costs to comply with those laws. Many years ago, when John F. Kennedy became president, we're talking 1960 now, one of the things that government did, one of the laws that were passed, gave consumers certain rights and certain protections under the law. Well, corporations have to set up customer service departments to take care of all of that, because prior to that, it was basically buyer beware. It was sort of the wild, wild west of consumerism. You bought something that didn't work, haha, I got your money, good luck, pal. But with these laws, it said, no, actually, businesses have to respond to customer demands. Customer service was born. Prior to that, there was no customer service type of stuff. So yeah, it was a government regulation that started it, but it's actually pretty good for customers. Another is civil rights, whether it's discrimination on the basics from the Civil Rights Act of 64 all the way through pregnancy in 1972, 73, equal pay, other types of things. Well, that meant a development of human resource departments as a specialty. And that cost corporations money to do that. But again, to me, it's not a huge deal. I think it was a reasonable thing for the government to do in many cases, because the government was reacting to many, many years of abuses. They heard horror stories and thus decided to act based on discrimination, based on other types of things. So yes, these laws and regulations affect corporations more than any other form of business. Yes, it's a disadvantage because it costs them money. To me, it's not the end of the world, really. It's one of those things. The other thing, the last thing that's mentioned here is the issue of additional taxes, which of course is a disadvantage. Why do they say it? Well, first of all, when a corporation makes a profit, they pay taxes on the profit. Okay, so they pay income tax. But what else can corporations do with that profit? Well, they can share the profit with the stockholders in the form of a dividend. So they send money to the stockholders in the form of a dividend. And what happens? Well, now the stockholders have to claim that as income, and that gets taxed. And so they used to call that double taxation. This book just says additional taxes. It is accurate as is. Okay. Okay. Another thing that's interesting is the structure of a corporation. Okay. You would think that the stockholders, being the owners of a corporation, have the most power in all of this. It's different. It's very, very different. First of all, stockholders are owners; they're not managers. So, who takes care of the stockholders? Well, the stockholders basically elect. They basically elect something called a board of directors. Okay. A board of directors of a corporation for a nonprofit, by the way, would be like a board of trustees. Okay. Um, but a board of directors sets policies that make the stockholders more wealthy. For example, if I was on the board of directors of, say, Pepsi, I would say, look, let's, in the next 5 years, let's see if we can take away 5% of the market share from Coca-Cola. Now, Coke is the number one soft drink company in the world. They're massive. Pepsi is a smaller number two, but they are solid. So taking 5% of the market away from Coke would be billions of dollars for Pepsi. And if that billions of dollars works, that would make the stockholders wealthier because that would certainly there's profits in those billions. So that would be one of the goals that you could set for as a board of directors. And that goal benefits the stockholders. It would make them wealthier over time. Well, the board of directors doesn't do it. They hire the executive team to do it. So the board of directors hires the president of the company and CEO of the company and all the upper executives of the company to say, look, we told our owners we're going to take 5% away from Coke over the next 5 years. That's the goal. You get this done. And so then it's up to the executive team, right, to hire and do all those other things to get things done. Right? So that's basically how it works. The problem is that there's a lot of criticisms on corporate CEO pay, right? Because there are large differences between what a chief executive officer makes and, say, the lower paid employees. That has gone. It used to be something like 100 times difference, and now it's well over, 1,000, 10,000 times difference. It's a huge, huge gap in terms of what the CEO makes of a large corporation compared to its employees, average on the bottom. And there are a lot of people who say this is unfair, et cetera. Well, the problem is this relationship right here. Because the people that serve as members of the board of directors of a corporation tend to be overwhelmingly CEOs of other corporations. So it's sort of like an executive inbreeding type of relationship between the board of directors and their CEOs of that company. They tend to be, like I said, most of the board tends to be CEOs, whether they're still active or retired. Most of them are CEOs or were CEOs. So they tend to treat the CEOs quite well. And the incentive is not just cash compensation is usually quite low, it's all those stock options that make the big difference in their wealth. So when a CEO of X corporation says they made $30 million this year, uh, probably about $1 million of that is their cash compensation, what you and I would just consider regular pay. The other 29 million is stock options. And so that's where they make most of their money in terms of compensation. And so, but who sets that up? The board of directors sets that up. The board of directors sets the compensation for all the executive team. So that particular relationship here is more problematic of the discrepancy in pay across the board. So when you hear that in the news, it's real, but this is where it's happening, and I'm not sure how to solve it. Okay. There are lots of other forms of businesses that we're not going to get involved with, but I will tell you that they are basically combinations of the best of the partnership form and the best of the corporation form. So whether it's a limited liability partnership or a limited liability corporation, they are basically lower tax and less liability. So lower tax is a benefit of a partnership. Limited liability is a benefit of a corporation. So most of these forms of businesses are just combinations of the best of both partnerships and corporations in one. Okay. So that's basically, we're not going to deal with them in detail here. To form a corporation, you need to apply with the state. Now, you can, just because you're a New York corporation doesn't mean you have to apply with the state of New York. There are 50 states to choose from. Business law, corporate law, is a jurisdiction of the state. So all 50 states have laws in place and applications in place in which you can create a corporation with them. You file that application with the Secretary of State's office, which is part of the state government. So the state government has a governor, a lieutenant governor. There's usually a treasurer, an attorney general. There's a Secretary of State. So these are statewide offices. So it's the Secretary of State's office that deals with these types of issues of getting applications in. They review them for lots of detail. There's a lot of detail on the application. So most applications are filled out by lawyers, which is why starting a corporation is a little bit more expensive a lot more expensive actually than starting a proprietorship or a partnership for that matter. So that application is reviewed to make sure everything is done, and there's a fee that's involved with it. I think the fee in New York it's about $200, a little less than $200, but it's a fee. The application is reviewed. If it's approved, that becomes what's called a corporate charter. That basically becomes your legal entity under the law. So the state now recognizes, Mike's Meal Ticket Incorporated, if I had a restaurant, as a separate corporation legally under the law, separate from Mike the owner, who's a person who happens to run it, happens to own it, but is separate under the law. So that charter is very important. It's the legal recognition that's there. And states require corporations who are granted a charter to come up with sort of bylaws, which is how it's going to be governed. And so that's something that also is part of it. There are some states like Delaware and New Jersey that have laws on the books that are quite favorable um, to corporations that are applied for and approved in that state. So a lot of times, even though we might be a New York business, we might consider applying to be a corporation in places like Delaware or New Jersey or South Dakota or other places that have more liberal laws for corporations. Liberal for corporations. There's more rights for them, less things to get in the way. Okay. Corporations that do business within the state is fine, but if you're doing interstate commerce, meaning you're selling state to state or around all the states, you need to apply for a license to do business in that state. So they recognize you. And of course, most states have taxes that they want to collect, and that's one of the more important aspects of the license as well. What if you're a stockholder? Well, there's certain rights that you have as a stockholder for common stock. You have a right to vote. Who are you voting for? You're electing the board of directors that are going to set goals for the company that make you more wealthy over time. That's one of the more important things. There are some states that require stockholders to vote on certain actions of the corporation. And so there are certain actions that stockholders have to vote for to approve. For example, one company is approached to get purchased by another company, an acquisition. Most of the time you have to get a stockholder approval for that. So that would be a policy. Do we sell ourselves to X corporation? Vote yes or no. It's very egalitarian. One vote, one share of ownership equals one vote. You have one share, you got one vote. You got 100 shares, you got 100 votes. You got 1,000,000 shares, you got 1,000,000 votes. One share, one vote. Another right that that stockholders have is that if the corporation is profitable, stockholders have a right to share in those earnings. And as we know, anytime a corporation shares a portion of its profit, that's called a dividend. It's simply a right to share. It's not a guarantee, simply a right. Another right that stockholders have is they have something called a preemptive right, which means they have a right to keep their share of ownership the same. Well, what does that mean? Well, let's say you are a stockholder in X corporation. You own 14% of the company. So you're a large owner in the company. 14% is a lot. The company wants to raise more money by issuing more shares of stock. So you have a preemptive right. You say, look, I get the first chance to purchase those shares because I want to maintain my 14% ownership in the company. And if you issue more shares, then my shares will be worth less in terms of a percentage of ownership. So I have the right to keep my ownership the same. So any new shares that are issued, I have the right to buy them first to keep my share. That's a preemptive right. And the last right really is not a right you want to exercise. In the case the company goes out of business totally, the worst case is a liquidation. The court says, sell all your assets. The purpose of selling those assets is to pay your debts first. So in the case that a corporation goes out of business, the first people in line are the people that lend the money. Banks have what we call super priority, which means that the banks are the first ones to collect money when a company goes out of business. Other lenders are after the banks that are not banks, they're after. If there's anything left after all the lenders are paid, then the stockholders get whatever's left. That's what a residual claim is. They get nothing. They get nothing. Everything is going to go to pay all the debts back, basically. Stockholders get nothing. So it's a right, yes, but it's not something you want to have exercised for sure. This is what a stock certificate looks like. It's looks quite official in most cases. All of these are registered, so all the owners of the shares are going to be listed with the number of shares that they own in a particular company. And so if you own stock, you either get a physical certificate like this, or it'll be electronic, digital. Right, why not? So remember, when you applied to become a corporation, it comes with, the application includes so many shares of stock. In New York, the basic application includes recognizing 200 shares of stock. In New York, it's 200, it's basic. You can have more, like I said, but 200 is the basic. Once your application is approved, well, then that means that 200 is now the authorized stock. In other words, that's the legally recognized number of shares your corporation is broken into by the state that granted it. Okay. So authorized stock simply is that legal amount of stock that's recognized. Okay. So again, that's very, very important. You're authorized to sell all of that, but again, it's simply, legally recognized, part of the application. What do you do with that stock? Well, now that you actually have legally recognized stock, you can sell some of it. The word issue, by the way, is to sell. Right? So a stock issue is selling stock. First, you have to decide how many shares of stock you want to sell and what price, how much money you'd like to raise. So the role here is to go to an investment bank. That's what investment bankers do. They are the fundraisers for our economy. So an investment banker helps corporations and governments like state raise money through either a stock offering, if it's a corporation, or a bond offering, if it's a corporation or a government. So that basically is what happens. Corporations usually go right through an investment banking firm. Investment banks usually are the ones that just give the money to the corporation, and then they sell those shares to their clients. When you and I actually get a chance at it, which is on the New York Stock Exchange or the NASDAQ, it's usually not. They're secondary markets because they're usually not original. They've already been bought, and these are owners that are reselling their shares, and so that's often what you'll see. All the shares on the stock exchange are resold. The original owners have decided they want out. Shares of stock are traded on stock exchanges, and the big one is the New York Stock Exchange. It's the largest one. It says physical stock exchange. You'll see it on Wall Street. Yes, has a trading floor. Blah blah blah. Nice. It's old, not as old as London, but it's old. The NASDAQ is another stock exchange, but it is electronic. There is a large building called NASDAQ in New York City, in Manhattan. But it doesn't have a trading floor. Everything is electronic, broker to broker electronics, like an internet of brokers. And they facilitate all of that. But it's a huge market. A lot of smaller companies are there. It's very heavy tech. If it's a very new company, it's probably going to be on the NASDAQ. To be on the New York Stock Exchange, you have to be around for a while. You have to have a lot of assets in order to be listed there. Again, around the world, London and Tokyo, very important exchanges to look at. Euronext is actually New York Stock Exchange is part of Euronext. The companies have merged, but Euronext runs some of the larger stock markets in Europe. So this is a worldwide thing. Now, when stock is issued, we have to do accounting for that. Remember, if we're going to raise money, that is going to be common stock. That's a stockholders' equity account, right? Okay, so we have to have some type of value there. Well, one of the things that we used to be required to do by state law is states would require companies to give their stock a par value. And that's just an arbitrary value that the company can make up as its core legal capital. So most companies gave par value of their shares very low, like $1 or even a penny. It doesn't matter. It was simply for accounting purposes. Didn't really matter. Okay. However, today most states don't require a par value. Again, some do. So what do corporations do? They basically say they have no par value stock. That's the most common. Okay. However, board of directors, because of the accounting rules, will sometimes, instead of having a par value, will assign a stated value to the shares. So it looks like par value. And you'll see what that means as we go through. So again, common stock is what we call paid in capital. Paid in. Owners pay the money in. Right? That's why it's called paid in. The other account that you're familiar with is retained earnings. These are the two accounts that we've talked about most, common stock and retained earnings. Common stock is considered paid in capital because owners pay money in to the company. Okay. Retained earnings is not considered paid in capital because retained earnings is the profit that's been retained. Okay, so those are the primary accounts that we've dealt with. In addition to common stock, there's another account called preferred stock. Preferred stock is also stock, also shares of ownership. But the difference is preferred stock has no voting rights. They've given up the rights that were talked about earlier. In exchange for giving up those rights, preferred stockholders get dividends first. They're guaranteed dividends first before the corporation can give dividends to common stockholders. And so preferred stockholders are owners without the voting rights that you saw earlier. And in exchange for giving up those voting rights, when the company has a dividend, preferred stockholders get it first, common stockholders get it next. Okay. Now this is where the par value comes in, okay, or the stated value. On the balance sheet, these three accounts will be shown in stockholders' equity. You'll have a common stock account. If the company has preferred stock, you'll see the preferred stock account. And you'll see, of course, retained earnings. But for common stock and preferred stock, they're going to be listed at a stated value or a par value. Okay. If the company raised a lot more money than that, which they always do, all that extra money they've raised is going to be in an account called paid in capital in excess of the par value. And you'll be learning more about this in the next objective. This is just an introduction. Okay. So there we have it. Our first learning objective was long. Not a lot of accounting, as you see, but a lot to understand. And so this particular chapter ends with some statements that are either true or false. Similar to partnerships, stockholders have unlimited liability. No, they have limited liability. They're limited to the amount of money they've invested. That's the most they can lose. Their personal stuff is not at risk. It's easy for a corporation to obtain capital through the issue of stock. Yeah, that's one of the benefits or advantages of a corporation is they can simply sell shares of ownership, that's the issuance of stock, to raise money. The separation of ownership and management is an advantage in the corporate form. Well, it could be. In this particular book, it is not an advantage. And so they look at that as false. I could make a case where it's true. um, but in this book, it's false. Just for you to know. We haven't gotten into this yet, but the journal entry to record the authorization of stock is to credit the capital stock account. Well, we haven't gotten into any of that stuff yet. So I think this is out of place. We'll be looking at journal entries in the next objective. All states require a par value. No, some states do, some states don't. Instead of a par value, there's also no par value. Some states don't require it. So that's why that's false. So that would be our review of objective 1. Again, lots of information to absorb, not a ton of accounting yet, but we will get into that in objective 2 and 3. You'll see a lot. Okay. Any questions?